Welcome back to the channel. I hope all of you are having a great day. So today I wanted to talk about one massive problem that we're having in the markets, and not just the crypto markets, but everything. And the problem is that there's no retail capitulation. Now, I know what you might be thinking is that, yes, we've already had the capitulation. We've already had a lot of people have realized losses already in the markets, but I do want to urge you guys to check out this video. Make sure you watch it all the way through. And some of the charts and the data that I'm going to be showing you might make you think otherwise. And until that actually happens, until the major capitulation happens, I really don't see the pain going away in the markets, and this could take a while. And before we get into it, make sure to go check out our newsletter where we're going to be posting 1 to 2 times a week on deep dives in terms of the technicals, the charts, the data, and everything in the cryptocurrency market. And obviously, link to that will be in the description down below. So the first chart that I wanted to look at is one from Bank of America that looks at the percentage of their private equity holdings in terms of assets under management. Now, I know that might be a little bit of a doozy, but basically what we're trying to look at here is how much is Bank of America holding for their clients? Are people selling off, or are people hodling and keeping their money with Bank of America instead of taking it out, selling, and having cash on the side just in case of a market downturn? So typically this is really important because whenever money is taken out of the markets, that's because of a possible big recession coming. People are scared. They're better off holding their cash instead of in the markets because, of a market downturn like something like this back in 2008. So what we're seeing is that we're seeing one of the highest levels of people continuing to keep their money in the markets, at least in terms of, Bank of America's private client equity holding. And private clients are not just your retail traders. I mean, these are people with a lot of money. They're not the institutions, but again, this is a substantial amount of money. And what we're seeing is that back in 2008, we had levels below 40%. During the pandemic, it was even at 54%. But what we're seeing right now is that, yes, even though the market is downturning, are we really seeing that much pain? We are literally at high levels, basically higher than when we were in the bull market right around here at 63%. So what we actually need to see is a little bit more downturn in terms of the markets, in terms of people capitulating, in terms of retail investors and private clients taking money out of the markets because they're not sure of what's going to happen next. Now, on top of that, if we look over at Fidelity, which is another massive company that has trillions of dollars under management, you could see that this doesn't go all the way back to 2008, but just in terms of when the pandemic hit right around these times and right around here, you could see that there's massive moves in terms of equity flows out of Fidelity. And again, we still have not seen that. We've seen $40 billion leave their equity funds, but right around here, we saw plus $100 billion leave, and these weren't even market downturns. These were just retracements in the market. And again, this was obviously that quick COVID pandemic drop. But what we're seeing is that money is not flowing out of these ETFs. People are keeping their money in the markets because they're just not frightened of it yet. And in terms of the market, when you're really looking at it, do you really think that this small little drop, yes, it is 70 something percent, is the end? This was quick. It was 1 bounce, 2 bounce to the downside, and now we just created our floor. Looking at this just from an objective standpoint, it really seems like we could continue to go down. And the chart that we're looking at is the total cryptocurrency market cap, which we're still sitting at $900 billion. So yes, we've lost over $2 trillion in value. But again, you have to ask yourself, this was pretty quick. When you really think about it, yes, this lasted maybe multiple months. Most of 2022. But again, is this really the bottom in terms of how everyone's been hyping this future recession coming up? People are talking about sovereign debt crisis, banks defaulting, Credit Suisse and Deutsche Bank defaulting. We have a bunch of things that are happening. And in terms of this being the bottom, I'm just not convinced. So what I wanted to do is to take a look at the 2018 bear market, see how long that lasted. And even though it's not perfect, it does give us a little bit of an advantage to see, hey, how long did this one last, and maybe how long will the other ones last? So currently we're on the daily chart, and what we're looking at is the 2018 bear market. So just to be fair, I'm going to take it from the top when it first started dropping, because now we know that in hindsight. So it started dropping in around January of 2018, which is very similar to what's happening now. We started dropping around November of 2021, regardless. So let's take it from the top, and then we're going to see how many days it was to this final bottom, which was around 344 days, right around to this bottom. Now, if we continue until the markets actually started to rise again, because again, yes, we had this fake rally to the upside, but then we had more drop to the downside. So until we actually started moving somewhere, the markets really consolidated for 800 days. So again, the bottom was technically set right around here, 344 days, but we really consolidated with no gains for another 800 days. And one thing to remember is that all the way from the top over here to the bottom, there was an 87% loss in the total cryptocurrency market cap. Again, a lot of that comes from the altcoins, but if we take a look at what's happening in the markets right now, what we have is all the way from the top to the bottom right around here is that we've only had 74% loss, which is still significant, but it's nowhere near that 87%, which if we did go all the way down to that point, we would still lose at least $400 to $500 billion in value. That doesn't all have to come from Bitcoin, but it does have to come from a lot of these altcoins. And if you're looking at the markets, I mean, the fact that Dogecoin is still in the top 10 and has a market value of $8 billion really tells you that people are still hodling, they're keeping their money in the markets. And do you really think that if we had a massive recession or a lot of downturn coming with major sovereign debt crisis, the banks basically getting very close to defaulting on their stuff, and an actual bear market, do you really think that Dogecoin and meme coin and Shiba Inu would have billions and billions and billions of dollars in their market cap and people continue to hodl? So that's my entire point with this entire thing, is that no retail capitulation has really happened. While yes, people have seen realized losses and we have seen losses in the markets, I'm not convinced that we've seen the actual retail capitulation that we've been waiting for. And again, if we take it from the top and go all the way out here, you could see that yes, the bottom may have been set in terms of the days, which again was around 334 days, which again is the bottom right here. So while yes, that is the same amount of time that it took for the 2018 bear market, we could still see sideways movement and possible more downturn all the way for at least another 800 days, which goes all the way into quarter 3, quarter 4 of 2023. So is the bottom in? Nobody really knows, right? Maybe this is the bottom. Maybe this is the lowest that we do go. But one thing I want to actually urge you guys to look at is that when we look at the charts, first thing is that when we go all the way from the top, you have this first move to the downside, and then a retracement, and then the second big move. Then what we're going to do is we're going to look at the 2018 chart and kind of compare that and see where we actually might be in terms of that. So for me, again, remember in 2018, we dropped at least 87%. We haven't hit that in 2022. But if we look at over here, we have that first major move down, that retracement, and the second leg down. The difference here is that we have a second retracement in the markets and that final move to the downside. This is where we had that slow bleed out, that slow grind, and then finally that drop to around $100 billion in market cap. But this again looks very similar to Bitcoin, where we had that slow bleed out, that $6,000 floor, and then that drop. What we're seeing here is that we've only had 2 drops, 1 retracement, and so what we could possibly see is another retracement back to the upside, maybe to around the area of here, and I think we can get one more sweep below these lows, and then we could have hundreds of days of consolidation to really solidify that pain for the market. I think we're going to have one more fake rally to the upside, give some people some hope, just like we did back in 2018, right around here in this retracement. And again, that third dip to the downside is what I think is going to take these lows out at least. And then again, we might just consolidate for the rest of 2023, which again will start to pair up with the Bitcoin halving coming in 2024. And again, one thing to consider is that we still have some room to drop. I mean, we've only dropped around 75% in terms of total crypto market cap. And when we look at the altcoins and the meme coins, there's still billions and billions of dollars of value. So dropping $400 billion, we're going to get rid of a ton of other crypto projects, and we're going to see what actually lasts. And another reason that I think we could see a little bit more pain, more retail capitulation, and a little bit more consolidation in terms of when we're actually going to see the next bull market is, again, the core inflation is the main problem in terms of what's happening right now. And on October 13th, on Thursday, just in 3 days from making this video, We're going to get the numbers for the inflation year over year for consumers, which they're predicting is going to be 8.1% or 8.2%. So that'll be interesting. And then this is what the Fed actually cares about, which is core inflation. Now, they're predicting that's actually going to go up from last month, which if it does, that's telling the Fed they need to be more aggressive in terms of rate hikes. And since unemployment went down, they kind of have the green light to do so. And that's exactly what the market thinks, because while inflation comes out October 13th, the Fed will actually come out November 2nd and tell the market, hey, we're going to raise the rates by this many basis points. And around 80% of the market believes that they're going to raise it another 75 basis points, which basically means it's going to put them at 4% for their federal fund rate. So again, what that means for the markets is that as these continue to go up, the interest rates go up, that's bad for risk assets. But one thing to keep in mind is that the markets are a little forward looking. So even if we do get 75 basis points, 80% of the market's already expecting it. So you're not going to get massive moves to the downside. But one thing that we do have to realize is that the macroeconomics right now are dictating what's happening in the markets. And just because we've had, 10 to 12 years of bullishness throughout the entire markets, I mean, if you look at the S&P, it's been going up for a decade. We do need to kind of reset, come back to reality, and basically wipe out a lot of these meme coins, zombie companies, and just hopium in the market. So that's everything I have for this video. If you guys enjoyed it, if you found some value, make sure to subscribe and like the video down below. Until the next video, we'll see you guys then. Peace.